Okay, let's dive into this. Welcome everyone to today's explainer. So today we're exploring a pretty massive shift in trading strategy that we pulled directly from the crypto trader source material. We're unpacking a genuinely fascinating paradigm shift, moving away from a fragmented, kind of piecemeal way of looking at charts, and instead moving toward a truly holistic approach. The text actually calls this achieving confluence. And honestly, diving into how it all works, well, it's quite an eye-opener. It's a real game changer. To understand why this shift is absolutely crucial, we really have to look at the ultimate directive from the text, which is stop relying on a single indicator. I know, it sounds incredibly simple, right? But man, it is a trap that catches almost everyone. I mean, we've all likely been burned by staring intently at one single green line, absolutely convinced a breakout is happening, while the rest of the market literally crashes around us. When you rely on just one metric, say, just watching a moving average or just looking at volume, you are basically flying blind in every other direction. You're putting all of your trust into a single data point in a highly complex, dynamic market. The source text makes it crystal clear. This single indicator reliance, it's a dangerous habit and it has to be broken. And that brings us to a very specific milestone in the text, day 14. Now, in the crypto trader timeline, day 14 isn't just, another arbitrary date on a calendar. It represents a pivotal graduation point. It's the exact moment in the curriculum where those dangerous beginner habits, like hoping one magical indicator holds all the answers, are permanently left behind. Day 14 essentially marks the line in the sand. It's where your trading mindset matures and you finally graduate to the big leagues.
So, what exactly happens on day 14? Well, we enter the era of candlestick plus indicator confluence. The text defines confluence as the act of combining multiple market elements and technicals to validate a strategy, rather than relying on just one. It's all about synergy. Your power doesn't come from discovering some secret, undiscovered indicator. No way. The power comes entirely from the act of combining different elements so they actually agree with one another. Think about it. When multiple independent signals all point to the exact same conclusion, your confidence in that trade naturally goes way, way up.
This completely illustrates the stark contrast between these two methodologies. The old single indicator approach is narrow, it's risky, and frankly, it leaves you incredibly vulnerable to false signals and market traps. But compare that to candlestick plus indicator confluence. This is empowering. This is where you are building a robust shield for your trade using a web of evidence rather than hanging by a single thread. It completely redefines how you interact with the market because it demands corroboration before you take any action. Let's see how this builds into actionable advice. If there's one word that jumps out of this entire explainer, it is this: combine. The text heavily emphasizes this action: combine. You aren't just casually glancing at a chart anymore. You are actively layering multiple confirmations. You're letting the weight of the evidence stack up. If element A says buy, you hold your horses. You don't move until element B and element C also agree for sure. So, what exactly are we combining? The crypto trader text methodically lays out 6 specific pillars that form this confluence checklist. First off, we have market structure, support and resistance, and volume. Then we add in our technicals, the exponential moving average, or EMA, which smooths out price action, the relative strength index, the RSI, which measures momentum to tell us if an asset is overbought or oversold, and the MACD, measuring moving average convergence and divergence to show us trend direction. This toolkit for day 14 is incredibly robust and comprehensive. You aren't just looking at price action, and you aren't just looking at math formulas. You are looking at the whole shebang altogether. What's really fascinating about this approach is how perfectly balanced it is. We can actually categorize this list to truly understand its brilliance. First, we have the structural elements, right? Market structure, support and resistance, and volume. These represent the raw underlying physics of the market. It's where the buyers and sellers actually are. Then we pair that with the technical indicators, the EMA, RSI, and MACD. These are the mathematical calculations that help us interpret the momentum and the trend of that raw data. By taking from both categories, you're cross-referencing reality with mathematical probability. You are actively proving your thesis from 2 completely different angles. Which leaves us with the ultimate question based on this text. Will you keep relying on a single indicator, or is today your day 14? We've seen the logic behind how combining structural elements with technical indicators creates a vastly superior, safer, and just a much more validated approach to the market. The source material essentially challenges us to stop looking for one magic bullet and start building confluence. Thanks so much for joining me for this explainer, and I'll catch you next.